It's very easy for someone to come up on a video like this and tell you, the market's about to crash, without any kind of fundamentals. I want to show you the economic factors why I think this market is about to crash. So you understand the big picture and you protect your money. Hi there, my name is Jaime Shekaiban. Welcome to my channel, The Foreigner in America, where I teach locals and foreigners everything related to their money. So if you're someone that likes money channels, personal finance, talking about the markets, investing, real estate, and every other money topic, make sure to subscribe to this channel and hit that bell so you don't miss any one of my two weekly videos. I also post on Instagram at The Foreigner in America, and make sure you check out my blog, theforeignerinamerika.com. We need to understand why the market is dropping. I mean, we cannot say that it's gonna crash just because it dropped a couple of percentage points here and there. I want to compare today's market with the dot-com crash of the year 2000s, using 11 economic factors that I will show you one by one, so you understand where we are now compared to where we were before the market crashed. So let's begin. Number one, S&P 500 Shiller-Cape ratio. So Robert Shiller introduced this ratio of price over earnings for the S&P 500 adjusted to inflation over the prior 10 years. Today, it's at 35, the highest it's been in the last 20 years. But before the crash, it was 44. So the bigger, the more likely the market could crash. Number two, American Association of Individual Investors statement. There was a big bullish sentiment back before the crash of 2000s. And we're having the same bullish sentiment today. Back in the days, it was 75% bullish, compared to today being 46. That's the only thing that can save us. But it's on the inverse side. So the more bullish people think the market is, the more likely for it to go bearish. Number three, volatility. This is an important one. So this bullish feeling about the market doesn't go well with volatility. The more volatile the market, the more you have this index, this particular index called CBOE VIX, which is an index that the higher it is, the more volatile the market is. During the last years, this index has been around 20 to 30, and it got to 37 in February of last year. And before the dot-com crash, it was only 33. So this means that there was one point in time last year where it was more volatile than before the dot-com crash. So beware for that. Number four, S&P market cap concentration. Right now, we're depending on very few companies to swing the market. Back in the year 2000s, 18% of the market was distributed for 5 companies, which were Microsoft, General Electric, Cisco, Intel, and ExxonMobil. And today, we're having the same situation. 21% of the market is concentrated on 5 companies, which are Apple, Amazon, Microsoft again, which is impressive, Tesla, and Facebook, same as before the crash. Number 5, personal savings rate. So right now, the personal savings rate is very high. It's at around 13%. And before the dot-com crash, it was only 4.5%. But what's happening right now? People are not going out, people are not flying, people are not entertaining themselves. So the only thing they're doing is just grabbing the cash and holding it. And they're holding all these stimulus payments. So when the pandemic is over, people are gonna go out like crazy just to spend money and spend money. So that 4.5% will be actually lower. And that's when the market can collapse. Number 6, IPOs. This is a very important one. So back in the days before the dot-com bubble crash, there were a lot of IPOs, of initial public offerings. You can see in this chart, between 97 and 2000, they averaged around 500 IPOs. But in 2020, we had 538 IPOs, averaging 35% returns versus a 74% return back in the dot-com crash. The problem is the SPAC companies, the special purpose acquisition companies. Those are companies created just for the sole purpose of acquiring a private company. And that's lowering the average. So we are close to what the dot-com crash was. Number 7, Buffett indicator. So Mr. Warren Buffett, he has his own indicator, which is that he grabs the total market cap, like the value of the stock market, and divides it by GDP. And he says that once that number reaches 200%, we're in a very high risk of a market collapse. Guess what the number was before the dot-com crash? 157%. Right now, it's on 200%. The market is worth around $42 trillion, and the GDP of the US is about 21 trillion. So be aware for that. Number 8, put versus call options. So this indicator is measured by the number of put options that investors buy, thinking that the stocks will fail or will come down, versus the call options, which is the other way around. The more bullish, it will send the ratio down. So right now it's a 0.4, the same ratio as in 1999 before the market crashed. Number 9, margin debt to cash. So right now there's a margin debt of around 778 billion compared to only 21 billion back in the 2000s. However, the important metric here is margin to cash, which is a slightly lower number at 172% now versus 179% before the dot-com crash. So this means people are speculating too much. I mean, just see what happened with GameStop. Number 10, Federal Reserve assets. We are sitting right now at a balance sheet of $7.4 trillion. That's almost 13 times bigger than what it was in the year 2000. But this is mainly because of the pandemic and the way the Fed has been printing and printing money like crazy. So Fed's assets amount for about 35% of GDP versus 4.5% GDP back in the 2000s. So what does this mean? This means that the economy is overinflated. And when it's overinflated, what happens? It could burst. And the last indicator, so you know that the market will crash, is the federal funds rate. So interest rates correlate perfectly with the stock market. And the Fed is helping this stock market stay in shape by lowering the interest rates so much. But what happens when the pandemic is done and you start having people spending all this money, inflation starts to happen, and the rates start to go up? This is where we're gonna test this market. And this market is the most interest-sensitive market of history. Let me give you a foreigner insight for this topic. The only way to protect your money against a market crash is by diversifying. So what I will do, if I were you, is have a percentage of your money in stocks and bonds to hedge a little bit. Have another percentage of your money in real estate, in rental real estate. And then you can hold another percentage, a smaller one, in cash reserves, either in a checking account, money market account, or just plain cash. And if you want, you can hold a very small percentage of money in cryptos, like Bitcoin or Dogecoin or all those good stuff. When you're diversified into these different asset classes, if the market collapses, then you might as well hedge yourself with the bonds, the real estate, and your cash on hand. And that cash is gonna help you buy into the market at a very cheap price. So just diversify and do not put all your eggs in one basket, please. If you like this video, please hit the like button and subscribe to this beautiful channel and hit that bell so you don't miss any one of my videos. And make sure you check my Instagram at The Foreigner in America and my blog at theforeignerinamerika.com. I post every week in all of them. So until then, I'll see you next time.